So today we are going to talk about one of the strangest phenomena in modern capitalism. We're going to talk about companies that are alive on paper but are economically dead, and we call them zombie companies. The businesses that refuse to die. Imagine a company that can't pay its own debt. They are barely making any money. The interest bills are piling up and basically crushing them. Yet, banks keep lending to them. And year after year, it survives. Even after 5 years, they are still alive. Even after 10 years, they are still alive. But the problem is, they are taking something. What they are taking are skilled workers and talent. They are taking up office spaces and real estate, investment capital, customer demand, market opportunities. But from whom? From healthier businesses. Businesses who actually have some fundamentals that could help them grow and increase their capacity, efficiency, and could actually benefit the economy. And hence, the real question comes out to be, why does an economy allow stop allowing failure? Is it helping them because weak companies help growth, or is it slowly poisoning it? And that's why it is one of the strangest phenomena in modern capitalism. See, what ideally should happen in a capitalism is, let's say we're talking about a restaurant which is profitable. What is happening? It is serving great food, customer rewarded, it grows and it thrives. But when we're talking about a restaurant who is losing money every year and eventually closes down, when this actually happens, the businesses who are losing money eventually close closes. What happens is, the resources that they were blocking, which was not actually helping the economy, these resources get transferred to actually profitable companies, like workers, maybe the capital, the building, they get transferred to it. And in capitalism we call it creative destruction, which is one of the most important ideas. So weak businesses fail, so resources like workers, capitals, buildings can be put to better uses. This process make economies more productive over time. So why failure stops happening? See, the problem is, when we are having an economic environment in which there are healthy interest rates, let's say the interest rates are 10%, so debt is expensive, right? Not all companies can afford for interest payments. You have to be responsible with your idea wherever you are investing it, and you can't recklessly borrow as many funds as you want to, right? You have to be knowledgeable about what you're doing, you have to be disciplined in your capital allocation, and you have to be professional with the money, right? So if the company is not capable of that, it eventually defaults. The market forces a reset, and there is bankruptcy or a restructuring. But the problem comes when cheap money era begins. When the cheap money era begins, interest rates are closer to zero, let's say 2%. Now, debt is affordable and accessible to everyone. The company can refinance easily. And what they basically end up refinancing is their old debt. So, basically, they are having and putting out new debt just to make sure that the old debt obligations are fulfilled, right? And yet they are able to survive another year and another, right? And this becomes extend and pretend. They're basically extending their old loan to make sure that they are basically extending new loan to make sure their old debt obligations are fulfilled, and they're not investing their capital in maybe opening new factories, new branches, new SKUs, nothing. They are just taking out more debt so they can fulfill their old debt obligations. So, how can we identify and define a zombie companies? See, we are talking about the cheap money era. So, one of the biggest tool to do that would be interest coverage ratio. And why? Because in interest coverage ratio, we take into account EBITDA and the interest expense. See, we have make sure that we have removed depreciation and amortization from EBITDA, right? And we come up with EBIT, right? So EBITDA is basically, it basically tells you that operating profits are enough to make sure that this interest is taken care of, right? So what do we do is we divide by interest expenses. What happens, let's say your EBIT is in situation 1 and 2, let's do that, right? Let's say here your EBITDA is let's say 2, right? And here your EBITDA is 1, and your interest payments, let's say remains 1 and 1. So what happens, the interest coverage ratio of 2 ensures that you have enough operating profit to make sure you have enough for the interest that you have to pay. This basically, this 2 is basically suggesting you that you have twice the amount in operating profit that you have to forgo in interest payments. But this is a problem. You have just enough money left in your operating profit to make sure that you are fulfilling your interest obligations. You have nothing left in net profit. Just leave out dividends, reinvestment, nothing. You have just enough operating profit to make sure that you are paying your interest obligation. So is that company a red flag or not? Obviously. And the problem comes into picture when, let's say, this EBIT falls back to, let's say, zero point 0.5 and your interest obligation is 1. You don't have enough operating profit to cover your interest as well. This is a major red flag. So what happens is company tends to renew their debt and continues paying the new money to the old money. The ratio below 1 for multiple years is a major red flag. The company cannot generate enough profit from their operation to pay its interest. It must borrow more just to survive. So let's compare. Now let's not label it initially. We are having a EBIT of 100 crores, interest payment of 20 crores. We have 5 times more operating profit to cover our interest payments. This is very comfortable situation, and this is definitely healthy. When we're talking about EBITDA of 100 crores and interest of 100 crores, you have exactly how much interest you need to pay. You are breaking even, nothing else. This is a danger zone, right? Here, if you are seeing a company with such coverage ratio, you have to be cautious about it, right? You have to red flag it. But this situation, a bit of 100 crore, interest of 150 crores, coverage ratio is 0.67, you don't even have money to fulfill your obligation. All you could do is constant refinancing. This is what a zombie warning is. Many zombie companies stay below 1 for years, and this is how you identify a zombie company. But why cheap money is created? See, when we are having a high interest rate of 10%, interest expenses are 100 crore per year. Let's say with a debt of 1000 crore, right? The company must generate significant earnings just to stay afloat, right? Like it happened here, right? This is what a healthy company should do. Survival is difficult without strong profits. See, survival here is not possible because eventually the tech changes, the buildings machinery becomes obsolete, not building of course, but machinery becomes obsolete. So you need to reinvest just in order to survive. But if your interest is such high, you can't get enough money to reinvest. Eventually you will become obsolete and you have to shut down your doors, right? So but what happens in low interest rate is interest rate just falls to 20 crores per year. This feels so much cheaper, right? With a 100 crore responsibility to a 20 crore rupees responsibility, this tends to open room for speculation as well as uh, more risky adventures, right? Suddenly, survival becomes much easier. The business never really improved, debt simply became cheaper, right? The business never become better, debt became cheaper. Cheap credit allows weak firms to survive without fixing their underlying problem. See, what happens when the interest rates falls down? You are having a bit of 100 crores only, but suddenly with the obligation of 20, your interest coverage ratio becomes 5. This comes out to be a healthy company. The same scenario here, right? So because the debt was cheap, but your obligation was still underlying, just because, see, you improved nothing in your company, only and only interest rates became cheaper, and that's why it is giving out a healthy signal. So now we have to understand the ripple effect as well, right? From micro to macro, how is it affecting, how zombie companies are affecting. See, being a zombie company itself is not a problem, right? One firm limping along rarely crashes any economy, right? People and ideas are bound to fail, right? Some succeed, some fail. It's totally normal in the micro level, right? But talking about at the meso level, entire industry full of weak firms. Let's say there's a particular sector who is filled with zombie firms, and the entire sector is collapsing, right? Hundred of zombie firms create distortions. Too many companies chase too few profits, and healthy competition struggle to go. That entire industry becomes so volatile. And in the macro environment, thousands of zombie companies become a systematic issue. Productivity eventually slows down, and systematic issue is something that you can't diversify, right? It's happening across the market. Capital gets trapped in weak businesses, innovation tend to suffer, and the economy loses its dynamics. Now, for the past videos, I've been taking into example the 2008 financial crisis. So I just decided to move to Japan because this case is actually very interesting. See, Japan lost decades because of what happened in 1980s. You remember back in March 2024, Japan was actually able to get out from negative interest rates. It actually became 0 to 0.1%, the interest rates in Japan. And this 1980 asset bubble was the reason behind it. The housing market and the stocks market soared to unsustainable heights. The market crashed. Many companies should have failed and have been restructured. Right? So basically, what happened? The bank's response, extend and pretend, instead of forcing defaults, banks kept supporting weak borrowers with repeated financing. And it turned out to be a big disaster for Japan, right? So I'll tell you more about Japan. What happened after this bubble bursted was that companies shifted their focus of working, and what they did, rather than being focused towards this, that getting new money to finance their old debt, they started to focusing on making profits, and whatever profit that they were generating, they were trying to make sure that their debt is reduced. See what was happening, they might have bought a house for $100 million as an asset, but due to the crash that became 10 million. So the asset has no value, but the debt still remains 100 million. So what they did is, rather than again putting out a loan for $100 million, they focused on making sure that this debt repayment is happening. Right. So basically, everyone started to pay back the banks rather than getting out new money. So bank had enormous cash deposit, and there were no one to borrow money, which eventually led to a deflation. Now what happens in inflation is prices tends to rise over a year. So a car might cost 10 lakh rupees today, but after a year it might cost 11 lakh rupees. But because Japan was going through a deflationary phase, what happened? Rather than money losing its purchasing power, it was gaining its purchasing power. A car that might today cost 10 lakh rupees, after a year it was going to cost 9 lakh rupees. The car today, if it's worth 10 lakh rupees, it would cost 9 lakh rupees. It was opposite of inflation. So people waited. They were actually piling up money in their homes, and they were waiting for a cheaper alternative after a year, right? So what happened is the Bank of Japan basically moved to negative interest rates. And how it did that, why it did that, was to tax the banks for keeping enormous money in their banks. See, it accelerated because during that time, what Japan tried to did is invest heavily on their infrastructure, right? So what they did is borrowed money through bonds. Now if they would have increased the interest rates, right, just to make sure we can come out of the deflationary phase, what would happen? There would be a massive debt liability for the government itself, right? The interest would eventually matter to the government as well, right? They also have the obligation to pay the debt. As soon as that was zero, it was okay, but even a 1 to 2% increase would have created a massive debt obligation for the government as well. So due to this particular reason, this zombie economy effect led to Japan being in inflation for around 3 decades. Right. So the hard lesson here is saving every company can create long term costs. Researchers found that Japan's zombie companies slowed economic dynamics and reduced productivity growth, and it prevented the reallocation of resources to more productive uses. The cost of preventing failures was preventing renewal, and which is a very, very important lesson to learn here. Right. So let's do a comparison. Right. Should zombie companies die, what will happen? See, resources would be transferred to a much better utilization. So it would increase the economic efficiency. The talent, the capital, the customers who are tied up in firms that are barely making any money, leave alone profits, would eventually go to more sustainable businesses. The competition would be dissolved and the market signals would be accurate. The slow innovation and the slow innovation would reduce and the productivity would increase, right? So but let's just take about why they should survive. See, when productivity increase, when the markets, the machines becomes more efficient, there is a significant chance of employment getting down, people being unemployed, right? So as long as that particular company is working, they are stable, they are alive, at least there's a employment protection. Not for long, of course, but people's livelihood is dependent on it. So this would be a case. So in an economy, bankruptcy is a major red flag, right? So if there are hundreds of zombie companies suddenly becoming bankrupt, this would again be a red flag for the economy, and which could lead to recessions, right? Survival maintains the financial system's stability. It prevents suppliers and banks, and short term pain can be politically and socially costly. Right? So, there's a core trade off: short term stability versus long term productivity. Preventing failure today can mean preventing renewal tomorrow. Now, this trade off you have to decide. This is not a simple good versus bad debate. It is focusing on whether we should focus on the short term stability or the long term productivity impact. Right? Zombie companies are not just weak businesses, they are a sign of cheap credit, maybe preventing the economy from reallocated resources to stronger and more productive firms. So, how do basically analysts spot zombie companies? Their weak cash flow is a very big signal. Their high and rising debt levels is a very big signal. We have talked about the interest coverage ratio. They are repeatedly refinancing and opting for debt rollovers, minimum revenue or profit growth despite the cheap credit, right? And they are dependent on low interest rates or government support to survive, right? You can maybe after watching this video research a lot about the zombie companies in India currently, and you can mention those companies in the comments. And which companies deserve the most scrutiny, right? So basically, let's say a coverage ratio of 6, a coverage ratio of 2, a coverage ratio of zero point 0.8 for 5 consecutive years. This is comfortable. This you have to watch closely, and this is a red flag. This is the hallmark for a zombie company. The company C, for 5 consecutive years, if this is happening, this is basically a hallmark, right? So, coming back to the formulas, I'm really sorry, EBIT divided by the interest expense, if it's below 1 for years, it's a major warning. Debt service coverage ratio, operating cash flow divided by the debt obligation measures the ability to pay the full debt service. What happens with EBIT is because it considers revenue, right? And there could be accounts receivables. So we need to focus on the operating cash flows as well. Now, debt to EBITDA. So total debt, if we divide by EBITDA, high ratio indicates a high leverage burden, right? Because let's say the total debt is 200, EBITDA is 10. So just by considering EBITDA, it will take approximately 20 years to fulfill that debt obligation. So EBITDA needs to be high if debt is high, right? The refinancing impact, debt multiplied by the interest rate, shows how rate changes affects the survival. Again, the 100 rupees debt obligation or the 20 rupees debt obligation, right? So the chain reaction of cheap money is quite simple. The central banks keep interest rates as low as they can. Debt becomes affordable even for the weak firms, weak companies who are already struggling. Rather than fixing their problem, they take on more debt. So resources like capital, talent, and customer, they are trapped, and productively growth and innovation eventually suffers. So the debate at the heart of capitalism is, should every company be saved, or does economic progression require failure? In nature, old trees fall so that new ones can grow. Economies may work the same way as well. Sometimes the cost of preventing failures is preventing renewals. This is a very important saying in this particular scenario. So this is basically a summary. I hope you like this video, and you can also check out my previous video to understand more about margin calls, liquidity, short selling, how RBI is printing money without actually creating money, and many more. Thank you.